Hello, investors and traders, and welcome to the weekly market report. I'm AJ Monte, and this is a one-year daily candle chart of the S&P 500 ETF, also known as the Spiders, and that's ticker symbol SPY. If you look at my charts, you'll see that what we did last week was we stepped up our stop. Some of you may have gotten stopped out here after it breached that 20-period moving average, and then it moved higher. But let me just say that this pattern right here is known as a hanging man. It's more or less a hammer candle found at the end of an upward leg. And while you might be fooled to think that, okay, let me buy that high, be careful, because there's things going on here this week, obviously, that are historic in scope. And we are now living in unprecedented times. And of course, a lot has happened since the last market report. So what I'm going to do here is, again, I'm going to go back and start putting some forecast lines on here, because you could see that although this is a green candle, we have a long stretch of green. It's known as a stale green light. And we have the oscillators down here, particularly the CCI, starting to pivot lower. So I think we'll see for next week is we'll most likely see another pullback towards this moving average, maybe not all the way back to it, but certainly an attempt to pull back. So I'm going to put a target on the SPY at 373.85. We'll leave that in place. If you are still long the market, then I would, again, caution you to keep your stop below this 20-period moving average right there. All right, so if you didn't get stopped out back here and you had a stop trailing lower, again, I would move that stop back up, but I am suggesting here, based on the evidence or based on the signals, that we'll most likely pull back. Now, with that said, let's take a look at the VIX, because for the most part, the VIX is inversely related to the S&P. I did say last week the VIX would most likely rally. It did. It blew past my target there, actually, and then, of course, pulled back to guess where. Let me erase these lines. Pulled back right to support. So we're sitting once again back on the 2-week support level for the VIX. The oscillators are still going lower. So what I would say here is that the VIX still has a little bit more room to the downside here, but ultimately I think it's going to bounce, because again, we have now a stale red light. That's a long stretch of red. We assume that a green candle will show up any day. That's the way we look at that. A stale red light is telling us that we're long overdue for a green, and therefore I'm going to put a price target back on the VIX for a bounce up to 2374, and that's going to be my 1 to 1.5 week forecast on the VIX. And keep an eye on that one, because it might even blow through that target. We'll have to see. Again, with all that's going on in the geopolitical scene right now, it's at that point where really anything can happen. So let's look at the diamonds. The diamonds, again, like the S&P, some of you may have gotten stopped out here. But again, what do we have? A hanging man right there. And I'm going to erase this, because all oscillators, if you look down at the bottom, this hanging man is bearish. I'm going to put a price target on the diamonds a little bit lower. All I'm doing is I'm looking to the left here and drawing to the right here. I'm trying to mimic the angles that we see over a 3 to 4 day period. You see this headed lower this way, similar angle here. I'm duplicating that angle. And on the way up, we now are showing a pivot point, actually, because even though the Dow moved higher, we're up 54 today. If you notice, we have a lower high and a lower low. So from a technical analysis standpoint, that is known as a pivot point. And we're also seeing this candle show up on lower volume. So when prices are going up and the volume is dropping, that's telling us the buyers are losing some of that momentum. And the CCI down here is hinging lower, as you can see as I magnify that. You see, we have a very convincing pivot point or inverted V there on the CCI. So I'm going to put a price target on the Dow, 306.93, right around January 14th. I'm going to put a a calendar target on that as well. So that's the diamonds. Look at the Qs. We're going to have a slightly different picture because we had an up day, and you can see that the oscillators are still going higher. Again, we trailed our stop. If you got stopped out, don't worry. Really, don't worry about that, because chances are you'll have another chance to get back into the market on any kind of a bounce. But look at the long stretch again of green right there. As I erase these lines, you'll see that we have a long stretch of green known as a stale green light. Not quite a hanging man, because a hanging man would have to have a long shadow, a longer shadow that's 1.5 to 2 times the length of the body. But the telltale signs of a possible pullback on the Qs as well is really seen in the CCI. We have some mixed signals here, but I'm still going to commit to possibly a little bit higher on Monday, but eventually a pullback by Thursday or Friday. Again, nothing earth-shattering, at least at this point, but I think a pullback to that 20-period moving average right around 309 would be in order for that one. So that's the Qs. Now finally, if we look at the IWM, this is the Russell 2000. Another interesting pattern, because this, out of all the indices that I pointed out, this one is looking the most bearish out of the bunch, and mainly because, again, we dropped briefly below that moving average, bounced, but look what's happening here now, folks. You pay close attention to this. This is very close to a hanging man. You have a gap below the market right here. See that more or less coincides with the 20-period moving average. The oscillators are moving lower on the CCI. It's overbought on the stochastic, and I'm going to forecast that we'll move back to fill that gap with a price target of 197.81. Now, for those that are brand new to technical analysis, understand this. The greatest value that you can get from a chart such as this is the fact that it is a great risk management tool. Knowing when to get out is important, of course, but I think knowing when not to buy is as important, maybe even more important, than knowing when to get out. Because if I'm telling you, okay, look, you're looking at the news, everything looks good, but then, we got this close to a hanging man, oscillators going down, just knowing to hold back a little bit and waiting for a better entry point on a gap fill level, where most of the time we see gaps fill and bounce, that is going to really help you quite a bit. And that's what I am more or less doing in teaching people how to read the charts, as I guess you could say a technical analysis ambassador, is to help you read the signals more clearly so that you're removing the emotions from the money-making decision. Otherwise, you become a victim of your emotions and you start making knee-jerk reactions to news headlines, and that most likely will get you in trouble. So if you like this video, please do us all a favor. Click the like button. If you feel inclined to share it with people who you think could get a benefit from this, traders, investors alike, maybe even some high school or college students. We did some calls with some college and high school students earlier this week, and they gobbled it up. Why? Because it's not being taught in any of the schools. So feel free to share it with the younger folks out there that are just learning. I mean, risk management is a great concept to learn about, and charts are a pretty fun thing to get your hands on. So click the share button, and if you like, make some comments, ask questions. I'll try to get to that. I can't guarantee you that I'll answer right away, but I do look at them. And finally, if you like to get notified when a report goes out, click that little icon that looks like a bell, and you'll get notified when this gets posted to YouTube. So again, thank you so much. Have a great weekend, and we'll talk to you soon. So long.